Have you ever seen a headline that just doesn't make sense? A company announces billions in profit, and then, in the very next breath, announces it's laying off thousands of people. In January 2023, Google, Microsoft, and Amazon all did exactly that. Google's parent company had just reported $60 billion in profit for the year, yet they let go of 12,000 employees. What is going on here? If these giants are making so much money, why are they firing people? The answer isn't what you might think. This isn't about companies struggling to stay afloat. It's about a cold, calculated strategy. Today, we're going to pull back the curtain on corporate decision-making and uncover the 3 real reasons why profitability and job security have become completely disconnected. By the end, you'll understand why this cycle repeats itself, no matter how strong the economy looks. Let's start with the most important audience for any big public company. It's not their customers, and it's definitely not their employees, it's their shareholders. Imagine you're the CEO of a huge tech company. You brought in $10 billion this year and made $1 billion in profit. Sounds amazing, right? But here's the catch. Last year, your profit was also $1 billion. You haven't grown. For Wall Street, that's a problem. Investors aren't just looking at whether you made money. They're asking, are you making more money than before? Are your profit margins getting bigger? Are you becoming more efficient? And this is where layoffs become a powerful tool. When you cut your workforce, you slash your single biggest expense. For most companies, labor costs make up 60 to 70% of their spending. So, if you remove 5,000 employees, you might save $500 million a year. Instantly, your profit margin jumps from 10% to 15%. Wall Street loves this. Your stock price goes up, and the shareholders are happy. This exact scenario played out in 2022 and 2023. During the pandemic, tech companies hired like crazy. Everyone was stuck at home, shopping online, and using digital services. But as the world reopened, that explosive growth started to slow down. Revenue was still high, and profits were still strong, but the rate of growth was declining. For investors who had bet on endless expansion, this was a red flag. They started putting immense pressure on CEOs to show discipline. The message was crystal clear. If you can't grow your revenue fast enough, you better start cutting costs. And so, the layoffs began. Not because the companies were failing, but because they had to satisfy the market's insatiable appetite for ever-increasing returns. The second reason is a bit more subtle. Companies are always trying to reinvent themselves. Layoffs are a quick and dirty way to make that happen. Think about a company that built its empire on one specific technology, but now sees the future in something totally new, like artificial intelligence. They have tens of thousands of employees who are experts in the old way of doing things. What do? They could retrain everyone, but that's slow and expensive. From a purely financial standpoint, it's often cheaper and faster to lay off the workers with outdated skills and just hire new people who are already experts in the new field. It's brutal, but this is the math that happens in boardrooms. We saw this happen in real time with the AI boom. Suddenly, every company needed machine learning engineers and AI researchers. At the same time, they had thousands of people working on projects that now seemed less important. Instead of a gradual shift, many companies chose to make sharp, deep cuts to reallocate resources quickly. There's also this concept called portfolio optimization. A massive company like Amazon or Google is really just a collection of many different businesses and projects. Some are thriving, and some are lagging. Even if the company as a whole is incredibly profitable, executives are constantly deciding which parts to invest in and which to cut. A division might be making a small profit, but if the leadership believes that money could generate a higher return somewhere else, they'll shut that division down. The people in that department lose their jobs, not because they failed, but because their work was deemed less valuable than a different bet the company wanted to make. This is why you see companies announcing layoffs in one department while simultaneously posting hundreds of job openings in another. They aren't shrinking, they're just redistributing. The third reason is maybe the most human of all. Companies just copy each other. When one major player in an industry announces layoffs, you can almost bet that its competitors will follow within weeks. It's not a coincidence. There's a powerful herd mentality among corporate leaders. If your biggest rival just cut 15% of its workforce and Wall Street rewarded them with a higher stock price, the pressure on you to do the same becomes enormous. There's also a safety in numbers effect. If 5 tech companies all announce layoffs in the same month, it's no longer a story about your company's bad decisions. It becomes an industry-wide correction. This gives CEOs the political cover they need to make cuts without facing as much public backlash. In early 2023, this was undeniable. Tech giants announced layoffs in a domino-like sequence, each one giving the next company permission to act. This herd mentality is also tied to management trends. For a few years, the big idea was growth at all costs. The advice was to hire aggressively and expand, without worrying too much about profit. Then, almost overnight, the trend flipped. The new buzzwords became efficiency and discipline. The same investors who had praised rapid hiring were now criticizing companies for being bloated. So CEOs, wanting to stay in sync with the current wisdom, adjusted their playbooks. No one wants to be the last one playing by yesterday's rules. So, what does this all mean? When you see those confusing headlines about a profitable company laying off its workers, you're witnessing a perfect storm. You're re-seeing the power of shareholder primacy, the belief that a company's main purpose is to make investors rich. You're watching cold corporate strategy in action as businesses reshape themselves without much thought for the human cost. And you're observing simple herd behavior as leaders follow the crowd instead of paving their own way. Here's the most important takeaway. For today's massive public companies, simply being profitable isn't enough. The goal is growth in profitability. The goal is expanding profit margins. The goal is a constantly rising stock price. In this system, employees are no longer seen as people with families and mortgages. They become a variable on a spreadsheet, an expense to be optimized. When executives talk about right-sizing or streamlining, they're talking about numbers. But behind every single one of those numbers is a person who now has to figure out their future. Even though the company they dedicated their time to just had its best year ever. This isn't going to change anytime soon, as long as a company's success is judged by its daily stock price. Layoffs will remain a standard tool in the corporate toolbox, used not as a last resort in tough times, but as a strategic move whenever it's convenient. The next time you see those headlines, you'll know the real story. It was never about survival. It was about something much more calculated. If this gave you a new perspective, consider subscribing to Business Paradox for more deep dives into how the world really works. Thanks for watching.